Warren Buffett's annual letter to Berkshire Hathaway shareholders is always an interesting read, and this year is no exception. There are some real surprises in there, but there's also a fascinating section about why Berkshire's been buying back its own stocks. Now, if you do want to learn more about news topics like this, but also how to invest generally, a really great way to do that, and it's free, is to sign up for our free weekly market roundup. You'll see a link beside me and in the description below. So now let's look at Berkshire's letter to shareholders in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. So let's start off with those buybacks. Now, Warren Buffett's view and Charlie Munger's view of buybacks is that they're okay as long as you don't buy at too high a price. Because if you do, you deplete the company's cash reserves and you end up reducing the value to shareholders. So the way they're spinning this share buyback is as a way of getting your hands on a bigger share of the jewels embedded inside the conglomerate. And they've certainly bought a large number of those shares, so about $25 billion worth. And their point is that this has given you a bigger share in the ownership of Berkshire's business family, such that now you own 5.2% more of those companies without having to spend any money yourself if you're already a shareholder. Because of course, if they reduce the number of shares, then your percentage ownership will go up because you hold more of the company. And when he's talking about those jewels, he's concentrating on just 4 companies of the many companies held by Berkshire. Now, the core of Berkshire Hathaway is its fleet of insurance businesses, and one of the jewels comes from this group. 2 of the jewels come from the railroad, utilities, and energy businesses, and then the final jewel is one of the companies which they've bought as part of their equity portfolio. So here's the first jewel which Buffett identifies. It's the National Indemnity Company. So they provide property insurance, but also casualty insurance. Now, because insurance is a core of their business, they need to have a large amount of cash or treasuries on hand so that if there's a big claim, they can make good on that claim. And that means that most insurers can't take too much risk with that cash. But because Berkshire's a conglomerate, it can use the other businesses to feed cash into this insurance business. And the second jewel is one of those cash cows which generates large amounts of cash which can feed into that insurance business. And that's BNSF. Now, buying a railroad is an extremely unsexy business. So for example, Cathie Wood would never go near a company like BNSF. It's not disruptive, it's old school, but the fact is that a very cheap way to move stuff from A to B in a very energy efficient, low friction manner is via a railroad. And in fact, if you order something on Amazon in the United States, there's a pretty good chance it's spent at least some of the time on BNSF's network. Now, of course, this is a very capital intensive business. You have to spend a lot maintaining a railway, but a lot of the network was already built when Warren Buffett bought it. And it is a very cash generative business, which sits very well amongst the other jewels, which we'll see. Now, Berkshire Hathaway owns some of these companies in their entirety. They bought the whole business. But in the case of Apple, they only own 5.4% of the company. But of course, it's a huge company, so that represents a very large investment. And for a long time, Warren Buffett didn't touch tech. But what this shows is that he has that flexibility to reassess his beliefs. And that's a hallmark of any great investor. And of course, Apple has been an extremely successful investment for them. And the fourth jewel in Berkshire's crown is Berkshire Hathaway Energy. And in this case, they don't own the entire company, but they do own 91% of it. And this one's kind of interesting because it doesn't pay any dividends at all to Berkshire. So let's go back to the ownership of Apple, because Buffett uses that as an example of why buybacks can be a great thing. They started buying their stake in Apple in 2016, and by the time they'd finished those purchases in mid-2018, they owned about 5.2% of the company. So the cost of that purchase was $36 billion. And since they started their purchases, on average, it's paid about $775 million per year into Berkshire's coffers. They sold some of their shares in 2020, and that raised $11 billion. So you might think that they own less than 5.2% today. But in fact, that's not the case, because those share buybacks have concentrated their holding in Apple such that they now own 5.4%, more than they owned in 2018. And that increase has been costless to Berkshire. And the reason for that is that Apple's been continually buying back its own shares. And that's illustrated really nicely in this graph, which is shared on Twitter from TradingView. Now, between 2006 and 2013, what you can see is a gradual increase in the number of shares outstanding from Apple. Now, that's because they were raising capital by issuing new shares. But because Apple's been so successful at generating very high sales, it has a lot of cash. And what it's decided to do with a lot of that cash is to buy back its own shares. So between 2013 and 2019, what you can see is this steady reduction in the number of shares outstanding. So it fell from about 6.5 billion shares in 2013 to just 4.6 billion in 2019. So if, like Berkshire, you're a shareholder of Apple, what you've seen is a steady concentration in your holding of the company. That means if they pay a dividend, for example, you're going to get a bigger share of the dividend. And remember that share ownership is part ownership of a company. So effectively, you do own more of the company. Now, there was a recent share split of Apple where you got 4 shares for every 1 that you were holding. And unlike a share buyback, that makes no effective difference in your holdings of the company at all. It's just a subdivision of your current holding into smaller units. So issuance of new shares dilutes your holding and generally upsets shareholders, and share buybacks concentrates your holding and generally makes investors happy. And because Berkshire's also been buying back its own shares over the last 2.5 years, the net result of all those buybacks is that you own 10% more of Apple's assets and future earnings than you did in summer 2018. And you can see this ramp up in the share repurchases in 2020. Now, what's also interesting about this is what Warren Buffett doesn't say. One of the things he likes to do is to buy other businesses. And the fact that he's buying back his own business shows that firstly, he thinks it's cheap, but secondly, he doesn't think other companies are cheap. If he did, he'd be out there buying them right now. So I think this is another sign, if we needed one, that markets are very highly priced at the moment. And as I said on Twitter recently, I think it's surprising how emotive a topic buybacks are considered to be. I shared this interview with Senator Warren, which was posted on Squawk Box, where she was saying why she thinks buybacks are a terrible idea. And Warren's main point, which was shared by many people who replied to me on Twitter, was that share buybacks often benefit executive share plans. And that's because if managers are compensated based on the performance of the company, then if there are less shares, then it's just arithmetic, then there'll be more earnings per share. And that could be a way of boosting bonuses if you are a manager compensated in that way. I don't think you could say that about Berkshire Hathaway, but I think for some companies this might be true. But certainly when it comes to valuation of a company, buybacks are effectively identical as dividends. And that's because they directly reward shareholders. So now let's turn to the concept of float. Now, this is cash held by an insurance company from all those premiums, but in the case of Berkshire Hathaway from all the other businesses, which they can then use to make a payout if there's a large claim. And the float held by Berkshire Hathaway is absolutely huge. It's $138 billion. Now, as we know, the yield on treasuries at the moment is extremely low. So it's absolutely no surprise that Buffett and Munger have decided to move that $138 billion into an asset which yields much more return. And of course, that's Bitcoin. Now, of course, they would never do that. And this brings me nicely onto the topic of bonds. And Buffett has a lot to say about this. And his point, as he was writing this letter over the last few months, is that bonds are not the place to be. And what he highlights is the yield on a 10-year US Treasury, which at the end of 2020 was 0.93%. And I've marked the end of 2020 with this vertical line here and the 0.93% yield which you received at that point. But of course, since this letter's gone to publication, you can see what's happened to US Treasuries. As I make this video, they're currently at around 1.5%. So since the low point in 2020, yields have now tripled. And that's been responsible for some of the sell-offs that we've seen in growth stocks, for example, and also for the outperformance of value, ironically, which of course is Warren Buffett's preferred investment strategy. But when they were at 0.93%, that was a massive fall compared to where they were during the 1980s, when they peaked at 15.8% during a period of very high inflation in the United States. And yet for someone who says he doesn't like bonds, he certainly holds a lot of them. But as we've seen, he has to hold at least some treasuries because that float has to be in a safe, low volatility investment. And what he says is that some insurers who can't hold as much equity as Berkshire can only juice their pathetic returns by shifting their money into bonds which are riskier. And that would mean buying bonds of companies with lower credit quality. And the reason why you do that is because those bonds pay you a credit spread which compensates you for that credit risk. But unfortunately at the moment, the credit spread has tightened to very low levels. Historic lows, in fact. So even though you're taking the credit risk, you're really not being compensated for taking it. So this would be a very poor solution for many insurers. And as he says, we've been down this road before. Risky loans are a very poor solution to low interest rates, as we saw in the savings and loan crisis. This is a plot of the number of failures of financial institutions in the United States every year. And you can see the savings and loan crisis created this massive spike in failures at the very end of the 1980s. And part of the reason for that was that savings and loan companies were investing in these speculative bonds. So Berkshire is in a very special situation where it can afford to take more equity risk than other insurers, and that way it generates more return than other insurers on its float. And what's great about Warren Buffett is that he confesses when he makes a mistake. In this case, the mistake was with a company called PCC, which creates parts for the aerospace industry, which of course has been badly impacted by the pandemic. And so this year he's had to take an $11 billion write-down, and he says that's a quantification of a mistake he made in 2016 when he paid too much for the company. And he openly admits PCC isn't the first error he's made of this sort. So for example, he also screwed up with Heinz, but this mistake with PCC, he says, was a big one. So personally, I take great comfort from this. Don't feel too bad if you make a bad investment, because Warren makes mistakes too. Now personally, the bit of the letter I like best is its inspiration for investing in the first place. Now it's not just about return. Let's go back to the example of Berkshire Hathaway Energy. I commented that one of the strange things about this company is that it's paid no dividend. Now that's very unusual for a utility company. Generally, these tend to be companies which pay very large dividends. But the reason given for that in the letter is that that money is being used to build energy infrastructure. A lot of the energy in the western part of the United States used to be based on coal, and the energy transmission network was very inefficient. So Berkshire Hathaway Energy is going to be spending $18 billion in order to improve that infrastructure. And this isn't a short-term plan. It started in 2006 and it's scheduled to end in 2030. And this leads Warren on to one of his favorite themes, which is why America is such a great place to do business. In order for a company to commit $18 billion to a 24-year infrastructure plan, they have to have faith in the laws of the country where they operate. They have to rely to some extent on political support, but also economic support from the government. Another favourite story of Warren's is about the founding of See's Candies by Mary C. She had great recipes for American candy, but she also used to serve it up in these quite quaint shops with friendly staff. Originally there was just one shop in LA, but that spread to hundreds of shops in the west part of America. And another founding story which Warren loves is the one about government employees' insurance company. So in 1936, Leo Goodwin and his wife Lillian were convinced that auto insurance could be sold more cheaply. Now they only had $100,000 in capital, but because there was a fair legal system, they could have a go at competing with companies that had 10 times as much capital. And of course, it was a massive success. And later on, the company was of course bought by Berkshire Hathaway. Another story which I love is the one about Rose Blumkin, or Mrs. B as she was later called, and she founded Nebraska Furniture Mart, which is now an extremely successful company. But it came from extremely humble beginnings. So she was born in Russia, just outside Minsk, as Rose Gorlick. She migrated to the United States in 1917, got married, and she became Rose Blumkin, and her first furniture mart was in the basement of her husband's company, and that was based in Nebraska. And then when her son came back from the Second World War, the business really took off. They expanded in the 1970s, and then in 1983 you can see here Warren Buffett buying a big stake in the company. So yes, of course, investment is about maximizing your return, but it has societal impacts well beyond that. And Warren Buffett says a wonderful thing. He says, today, many people forge similar miracles throughout the world, just like the stories we've just seen, creating a spread of prosperity that benefits all of humanity. But America is the real crucible of wealth globally. In its brief 232 years of existence, however, there's been no incubator for unleashing human potential like America. And he ends the section by saying, our unwavering conclusion is never bet against America. So that's my take on his 2020 letter. I really recommend that you read it for yourself and his previous letters, because there are so many gems of wisdom that we can all learn from. And if you want to carry on seeing gems of wisdom from our channel, then now you can support us directly on YouTube. You don't have to go to Patreon. There should be a join button underneath this image. You should be able to just click on that, and then you can support our independence and make sure that we can carry on making these videos. And there should be a link in the description too, if you're on mobile. And as always, thank you for listening.